A stock market crash can wipe out trillions of dollars in the blink of an eye, cutting investor portfolios in half pretty much overnight. But there are always telltale signs that lead up to a major market correction. And while stock market crashes may not be predictable, what's more important is not the amount the market corrects, but what you do when it does. And in this video, we're going to discuss what always leads to a stock market crash and what you should do when the inevitable happens. So let's jump into it and take a look at the economic indicators that you can watch in order to protect yourself from a future market crash. And then at the end of this video, we're going to discuss what to do when the inevitable actually happens. And we're going to start by taking a look at the VIX. This is the famous Warren Buffett predictor of market volatility that often indicates that a correction is coming to the market. However, this isn't always accurate, because quite often the VIX is an indicator that in fact is a lagging indicator. The volatility in the market is often something that goes up when the stock market is already plummeting. But if you take a look at the VIX, you can see very clearly that when there are times of volatility, that yes, in fact, the stock market is often on the decline. But very rarely is there enough data from the VIX to indicate that trouble is coming. And if it does in fact predict that there is going to be trouble in the market, you need to be able to act on it pretty much instantly if you are trying to time the market. And quite honestly, timing the market is often the thing that gets people in trouble, because even in times where the volatility index is increasing, it doesn't necessarily mean that there is a stock market correction coming. Just take a look at these periods right here, for example. So if economic indicators like the VIX, which are often seen as reliable as telling us whether or not the market is actually coming down, aren't really that reliable, well, what circumstances actually lead to a market decline? But before I get into that, if you want the truth about personal finance, the truth about money, no BS, no crap, do me a favor, hit that subscribe button, hit the like button so more people like you can see this video. Well, in order to understand that, it helps for us to take a look at the major stock market corrections over the last 100 to 125 years. And yes, there have been corrections that have seen stock market portfolios reduce by up to 89%. But for the most part, market corrections aren't this severe. In fact, most market corrections, which is defined, as I'll talk about a little bit later on, by a 10% reduction off the peak, happen pretty frequently. But the big ones, the really big ones, don't actually happen that often. And when we take a look at the major stock market declines over the last 125 years, you can see that there are 4 or 5 that really lend themselves to this discussion. The first is the crash of 1929 and the Great Depression. The second is the 1937 to 38 recession. The third is the bear market of 1973 and 1974. The fourth is the dot-com bubble burst. The fifth is the financial crisis of 2008. And last but not least is the most recent major stock market correction, which was that of COVID. Now, as you can see, stock market corrections similar to that of the Great Depression are rare. Even during the financial crisis, the stock market losses were nowhere close to what they were in 1929. But that doesn't mean that society doesn't live in fear of a major stock market correction. And as a result, that has many people do the exact wrong things when they see trouble ahead. And at the end of this video, we'll discuss what the major mistakes that amateur investors make when the stock market does indeed correct. But before we do, let's start by defining a stock market correction and talk about the 5 primary things that lead to significant corrections. So a stock market correction is typically defined as a decline of 10% or more from a recent peak. Now, that decline can happen very quickly, like in a single day, or it can happen over several months or even years. But as far as major corrections go, it's a pretty significant drop before we can start calling a stock market correction a crash. And when it comes to the common factors that lead to a stock market crash, there are 5 things, and these are ordered in the order of severity. The first is valuation and market conditions. The second is economic and monetary influences. The third is external shocks and geopolitical events. The fourth is investor behavior and psychological factors. And the fifth is policy and technical factors. And I'm going to go into a little bit more detail on each of these as well as provide examples. So let's start with valuation and market conditions. So the 2 conditions that have led to the most severe economic crashes are overvaluation and excessive leverage. Now, when we talk about overvaluation, we talk about times like the dot-com bubble, where there were clearly a significant amount of tech companies out there that had zero chance of ever making a profit, but the valuations due to the herd mentality were going up and up and up. And it was very clear in hindsight that those valuations were definitely nowhere close to where they should have been. And major investors like Warren Buffett took a look at the dot-com bubble and said, this is not something that we want to have anything to do with. In fact, years later, there are very few companies that actually survived the dot-com bubble burst. Most of the technology companies that ran up in price during that time went, well, the way of the dodo bird. The main exception to that was, of course, Amazon. Then there were periods like the 1929 crash, where there was both excessive leverage and overvaluation due to cheap credit that led many people to borrow money in order to invest, with the assumption that they could only buy stocks that would go up in value and that there was very little chance of losing money. And of course, those two assumptions, well, they proved to be very much wrong. But what the dot-com bubble burst and the 1929 crash and the Great Depression teach us is that there are two primary things that lead to the biggest stock market crashes. That is mass hysteria, which leads to overvaluation, and the borrowing of money in order to purchase investments, whether that's stocks or other investments like homes and investment properties, similar to what happened in the 2007 to 2008 financial crisis. Bottom line here is if the valuation of things seems too good to be true, it probably is. And if you're going to borrow money to invest, that is probably a very good sign that bad things are about to happen. Because borrowing money in order to invest not only increases the amount of risk that you have, but it also means that there's probably a whole bunch of other people doing it, which is leading to the first piece, which is those overvaluations. Now, the next major circumstance that leads to stock market crashes is economic and monetary influences. And there's two primary concerns here. The first is during periods of rising interest rates, like the 2022 correction that happened as the Federal Reserve increased interest rates post-COVID, as well as economic slowdowns like the COVID-19 crash, the 2007-2008 financial crisis, which really wasn't stock market related. It was more housing related, but nonetheless, the economic slowdown did in fact lead to that significant crash. And then things like the 1973 and 1974 bear market, which was largely caused by the OPEC oil embargo, which led to a significant shock to the market and a significant slowdown in the economy. The next type of economic circumstance that leads to pretty significant stock market crashes is external shocks and geopolitical events. Look no further than COVID-19 as an external shock, or the previously mentioned oil embargo that led to the 1973 and 74 bear market. Now, these types of geopolitical events and external shocks don't typically have a significant impact on the stock market itself, but they do create fear within the market that leads to significant corrections. And those corrections can happen very, very quickly. And going forward in the future, as things happen worldwide at a much quicker pace due to technology, these types of flash crashes will become more and more prevalent. And that leads us to investor behavior and psychological factors. So quite often when external factors rear their ugly head, market sentiment actually compounds the issue. It makes the corrections deeper and faster as a result of amateur investors flocking out of the market as quickly as they can because they don't know what to do when the market actually corrects. And not only that, the tendency of amateur investors to chase past performance leads to things like the dot-com bubble and the 2022 correction, where interest rates started to increase, which had many people believing that a 1970s or 1980s style crash was coming because that's what happened back then. And those psychological factors play an important role in a market shift that happens quickly. And last but not least, there's always policy and technical factors. So changes in banking regulations, changes in government policies, changes in tax rates can lead to stock market corrections. And not only that, there's also technical factors that can lead to stock market corrections as well. And two primary examples of that are the 2010 flash crash, which was largely due to algorithmic trading, and 1987, which was Black Monday, which was largely the result of a new style of trading, which was automated trading, which led to a feedback loop, which caused many stocks to sell off as triggers were hit that automated the process of creating more sales. Now, these five major factors are often clear in hindsight, but very rarely are they possible to predict before a stock market correction happens. And no matter what anybody tells you, the Peter Schiffs of the world, the people who claim to have predicted every stock market crash that happened, very few people actually get this right. And quite often, the people who claim to have gotten it right are just purely the types of people who are always predicting a crash, naming all the potential things that they can see wrong in the economy, and then using the fact that they named pretty much everything under the sun that could go wrong as something that could go wrong as evidence that they are able to predict the future. And with the exception of people like Michael Burry, who made massive bets on the collapse of the US mortgage market and subsequently on the collapse of the US economy, there are very few people who have actually made out like bandits when it comes to these corrections. There's just simply something that people don't see coming, even though it's obvious in times like the dot-com bubble, where you could simply tell, in hindsight, of course, that there was going to be a correction due to the fact that there was all these companies out there that were valued way higher than what they should have been, even though they had no revenues to their name and absolutely no economic model that made any sort of sense for them to be valued at $1 billion or more. And that leads us to a conversation around the biggest investing mistakes that amateurs make. Because while in hindsight, it's quite clear what always leads to a stock market crash, what to do during a stock market crash isn't so obvious. And there's one investor that clearly has his thumb on the pulse of what not to do and what to do during a stock market crash, and that's Warren Buffett. So rather than me telling you what you should do during a stock market crash, because let's call a spade, you probably shouldn't be taking your investing advice from random dudes off of YouTube who are making videos. I found these 7 biggest mistakes, according to Warren Buffett, that people make when it comes to a stock market crash. And the very first and the most obvious is panic selling. This quote from Buffett sums it up quite nicely. The stock market is designed to transfer money from the active to the patient. And as you'll see as we go through these, there is a lot of conversation around being an active investor who's trying to time the market versus being a patient one who simply makes good investments and waits them out over a long period of time. Because at the end of the day, the people who lose money when the stock market crashes are the people who sell and miss out on the really big upticks that inevitably happen after a stock market correction. The next major mistake that amateur investors make is ignoring the fundamentals. Price is what you pay, value is what you get. So when you look at the dot-com bubble crash, a lot of people were paying high valuations for companies that really had no value whatsoever. They had nothing more than a domain name with .com behind it, a nice brand, and no economic model. So when it comes to investing, it's important that you pay attention to the fundamentals. Buying things like Bitcoin, if you can't identify what the fundamentals are and the exact reasons why you're buying it, is probably a fool's errand. Now, I'm not saying that you shouldn't be buying Bitcoin, but I am saying that you should understand why you are buying it and how it plays into your overall portfolio. And you definitely shouldn't be putting all of your money in things like Bitcoin or gold, because doing so without understanding how they play into your overall portfolio is what ends up costing people a significant amount of money when inevitably the corrections happen, just like they did during the dot-com bubble bust. The next mistake people make is overreacting to market volatility. When the market has a slight decrease in value, people tend to go out and sell because they think that they need to get out before a crash happens. And there's an interesting stat that over the last 30 years, if you'd missed out on just the 40 best trading days, your returns would have gone from on average to being negative. So selling during times of market volatility means that you're often not bought in when the market turns around. And this right here is in fact one of my favorite quotes from Buffett. It's be fearful when others are greedy and greedy when others are fearful. So in other words, don't run out of the market when stocks go on sale, and definitely don't be buying at a breakneck pace when they're being sold at a premium. So in other words, the common mistake is to buy high and sell low, when what you should in fact be doing is trying to buy as much when stocks are priced low and potentially sell when they're priced high. Now, the one caveat to that is it's often hard to predict when a stock is priced high. And quite often, when you think there's no more room for a stock to run up in value, it continues to run and run and run. So the best strategy is to be a passive investor rather than an active one. Buy really great stocks or investments like S&P 500 index funds and simply hold on to them for as long as you possibly can, buying more when they go down in value. Or even better yet, do what's called dollar cost averaging, where you are buying stocks at every single opportunity, regardless of what the price is. And over time, you will accumulate both during high times and low times, and your average returns will increase as a result. The next mistake, and we see this so much right now, is following the crowd or the herd mentality. You can't buy what is popular and do well. Jumping into Tesla stocks at its high, jumping into Bitcoin at its high are fool's errands. You need to make smart investment decisions rather than buying things that are overhyped. And this is particularly true as well for gold right now, which at the time of this filming just hit $2,500 for the first time ever. And I can tell you right now that the hysteria around buying gold is going to be something that over time, as the market cools out and things get back to normal, is going to wane, and that's going to lead the values of gold eventually to come down quite significantly. So the people who are buying gold, believing that it can only go up in value, are yet to realize that gold does in fact fluctuate just like every other market, and you can lose a significant amount of the value very quickly. The next major mistake people make is trying to time the market. The stock market is a no-called strike game. You don't have to swing at everything, you can wait for your pitch. Which means that if you're trying to wait for a stock to go down in value or you're trying to sell at the top, you are more often than not going to be wrong in your predictions. And as a result, even though you think that you're a great investor, you're probably going to miss out on a significant amount of the returns. And even worse, if you are someone who is a day trader, for example, you might actually end up going negative and losing all of your money. And it's important to understand that investors often overestimate their abilities, thinking that they can outperform the market, when in fact the possibility of doing that is actually very, very low. In fact, for most people, it's almost impossible. Then there's the lack of patience. The stock market is a device for transferring money from the impatient to the patient. And this goes back to the same conversation around market timing. If you're trying to constantly hit home runs and get big returns, there's a good chance you'll lose a significant amount of your money. Now, contrast that to people who invest in the S&P 500 and just let their money grow. Well, more than likely, those people who are patient are going to have far greater returns and a far bigger nest egg 20, 30, or 40 years down the road. Then last but not least is focusing on short-term losses. This is where people make major, major mistakes. It's when they see the losses that they had, like in 2008, and they get out of the market for fear that their losses will increase. And the only people who really lost money during the 2008 financial crisis are the people who sold all of their investments and got out of the market because they were scared that if they didn't, they would lose more. And yes, it took a pretty long amount of time for investment values to come back up, but eventually they did, and they always do. And Buffett said it really well when he said this: in the 20th century, the United States endured 2 world wars and other traumatic and expensive military conflicts, the Depression, a dozen or so recessions, and financial panics, oil shocks, a flu pandemic, and the resignation of a disgraced president. Yet the Dow rose from 66 points to 11,497. So here's the reality. If you're always in the market, if you are always invested, over time, you are almost guaranteed to see your money grow in value. But when you focus on the short-term losses, you sell, and you get out of the market for just a very short period of time, well, you potentially leave thousands, if not hundreds of thousands, if not millions of dollars on the table. So the best thing that you can do during a market correction is to simply stay in the market. And even during really hard times like recessions, it still makes sense for you to continue to invest and leave your money invested as long as you don't need it to pay off debt or get yourself out of a financial hardship. Oh, and by the way, if you want to see the signs that always lead to a recession, make sure you check out this video right here.